welcome to your Monday Futures Market Outlook for September 20th, 2010. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eMoneySource.com trading room, we do have 5-day complimentary memberships available on the homepage. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot that 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. Now, we crossed bullishly above that earlier this year, and subsequently have now been consolidating, but consolidating above that 80-week moving average. One of the scenarios, and now what's becoming more and more likely the scenario, is that we had a market consolidation lower, and now we're now springboarding higher for another leg of a rally, probably up to 1250, maybe even 1300 on the upside over the course of the next few months. And into the new year. Subsequently, though, the one thing we still technically cannot rule out, and this is why we've had a bearish bias up until now, is that we could not rule out the possibility that this entire rally has been nothing but one corrective pattern in a primary downtrend. And so really at this stage, if we immediately off this level started seeing some deterioration in the markets and the economy, and especially a break below the 1,000 level on the S&P, would start we'd have to consider a number of more bearish scenarios. But at this stage, anything especially that breaks above the 11, 25, 30 area really starts to open the window for a multi-month year-end rally. Next here, I want to take a look at the S&P 500 on a daily chart basis on the futures. And more or less, we had those bottoms coming around that 1040, 1050 focal point. And now we're right testing into that 1120, 1130 focal point up above. Now, as much as we've already seen a little bit of a reversal candle and some consolidation up at these higher levels, there are a number of measured moves that point to the 1140, 1150, and 1160 targets on the upside. So even though this is a significant overhead resistance, there's nothing stopping the market from still having another 20, 30 S&P points thrust on the upside on the very short term. But nonetheless, whether we first get a rally up to that, let's say 1150 level on the upside, or we find the overhead resistance here at some juncture, and maybe even starting this week, we're probably going to see some sort of a market profit-taking cycle, whether it's the Tuesday FOMC meeting or whether it's some catalyst later in the week. At some stage, we will probably have one good down day, but that will not make us look at the market bearishly. There would have to be some very significant technical damage done to this market for us to really start to visit some bearish technical scenarios. We're really looking for probably what would be nothing more than a 2-3 day market pullback that at best puts about 20 to 40 S&P points to the downside, and then we'll use that to revisit the idea of going long the market from there. Just to review our key points, our thesis since January 2008 has been that we were in a secular bear market, and that thesis has been pretty much with us for almost 3 years now. But we are now considering changing that to a bullish stance, particularly if the market proves to be able to overcome some of these key technical levels here and continues to strengthen and particularly what I want to see is when one of these profit-taking cycles comes in, if we see again only a few days of selling and then subsequently a new thrust higher in the markets, we'll then start to visit those bullish scenarios and probably change our thesis. The bulls held that level at the 1040, 1050, and so now that inverted head and shoulders pattern is developing with a confirmation of breaking above this 1120, 1130 area that we've been talking about. We're testing that zone right as we speak. Some short-term measure moves are up to 1150, 1160. So if you are looking for a break of that head and shoulders neckline as your confirmation to rush out and buy, that probably may not be the best of ideas. As the market approaches those overhead resistance levels, we would then immediately get a profit-taking cycle coming back, which will really be where the buying opportunity emerges. So I would not be rushing to be accumulating at this stage. There are a number of new cross currents at play, which have now at minimum stalled that downtrend. And we now are starting to look at a number of scenarios, including trade range bound markets or bullish ones. Key thing is that investors can cautiously start to commit to the market, but recognize that there is no confirmation yet. Next here, I want to take a look at the NASDAQ 100 using the futures contract, and more or less that 1910 to 1930 area was nicely broken. We had our upside targets going maybe even as high as the 1980 era. Very interesting that the NASDAQ has already made those upside breaks while the S&P is still actually struggling at that line. It'll be very interesting to see whether the NASDAQ can maintain the strength. At some juncture here, the NASDAQ will go through a profit-taking cycle, whether we first get a little extended move as it pushes back towards the April highs. But nonetheless, accumulating the NASDAQ here without having a 1 or a 2 day pullback, you can certainly do so, but you would certainly need to keep all your stops with a wide enough range to make sure that you don't get stopped on any profit-taking cycle. Next here, I want to take a look at the dollar index futures, and the U.S. dollar has significantly weakened last week, breaking a key 82 level. Now it's finding support, what we now have defined as the 81.50 support line. Subsequently below there is about this consolidation zone around the 79.5 to 80 zone on the downside. Those two levels are going to be very important for the U.S. dollar. If the U.S. dollar, for whatever reason, was to deteriorate below those levels, it would certainly become very bullish on a number of other currency pairings, and subsequently it would drive a bullish price on oil and a number of other commodities. We're going to be watching very carefully as the U.S. dollar consolidates down here, as it would send a number of intermarket relationships into play. Next here, I want to take a look at gold futures, and gold is slowly now this morning approaching our 1290 1300 target on the upside. We were looking for potentially last week to be a little bit more profit taking before this happened, but a very shallow consolidation was all it needed for a springboard to launch above that 1260 level. Really, at this stage, the first minimum target is that 1290 to 1300, but there are some upside measured moves that go even as high as 1340 on the upside. As much as we continue to think that there may be some more bullish price action on the upside, just like we were talking about a month ago on the 10-year Treasury notes, at some stage there will be a consolidation or a profit-taking wedge that develops here. So really, at this stage, if anyone that remains bullish on gold needs to have a profit-taking plan in place and a contingency way of actually exiting the trades if and when the profit-taking cycle begins. Next here, I want to take a look at the E-mini crude oil chart. We more or less had a technical breakout above that 75 level that immediately reversed itself on the downside. But I would not be ready to be looking for a number of bearish scenarios on oil as the U.S. dollar is breaking down. As a matter of fact, if the U.S. dollar deteriorates, then we expect that the crude oil to be able to reverse this and actually start testing up higher. If on the same regards, if the dollar index does not break down and stays rather range bound, then oil could come back and retest that 69.71 zone. But at this juncture, too many bearish scenarios don't exist, so we're just going to be watching whether or not there could be an immediate recovery or far more range bound markets here. Finally, I want to take a look at the 10-year Treasury notes, and just like we were talking about in gold, and we see something very similar. We had upside targets on the 10-year Treasury notes up into the 126 to 126.5 area on the upside, and subsequently that's where the corrective wedge came in. We anticipate gold to do a similar pattern like that, but not without gold first maybe even going as high as $50 more per ounce from where it is. So, but nonetheless, when we're talking about these Treasury notes, this is now actually just looking like a very natural wedge consolidation, and the price action in the last week has actually been positive. We're going to be watching whether or not this 123, 123.5 focal point continues to maintain support. If it does, any technical breaks above the 124.5, 125 area on those Treasury notes actually opens the window for maybe a double top retest up at the 126 area, or maybe even a higher move. But to consider those scenarios, we first need to see a positive day that breaks above the 124.5. So we'll see how the price action develops right in here. That was your Monday Futures Market Outlook. Thank you for joining me.